When you really sit down and think about retirement, the idea of just relying on Social Security, it probably leaves a lot to be desired, right, in terms of comfort, financial freedom.
Yeah, absolutely. Most people are hoping for something a bit more substantial than just the basics.
Exactly. So what if there was a way to maybe generate a more significant monthly income, through a carefully chosen set of investments? That's actually what we're digging into today. We're going to explore whether a portfolio of 6 specific funds could realistically aim to generate around, say, $5,000 a month in income.
It's a really interesting goal, and the sources we're looking at give us a good breakdown of some specific income-focused funds and strategies.
Right. So the mission today is to see how these work, what the potential is based on, well, the info we've gathered.
And really get into the details, beyond just the surface description, understand how they operate, what might affect that income stream.
Okay, let's jump right in then. First up, JEPQ. That's the JP Morgan NASDAQ Equity Premium Income ETF. Now, JP Morgan's goal here seems to be monthly dividend income. They invest in the big tech players, Apple, Microsoft, Google.
The usual suspects.
Yeah. And then they add something called covered call options. Can you break that down simply? Like, what are covered calls?
Sure. So think of it like this. The fund owns shares of, say, Apple. They then sell someone else the right, but not the obligation, to buy those Apple shares at a specific price in the future.
Okay.
And for selling that right, the fund gets paid a fee called a premium right away. That premium becomes part of the income the fund generates.
Ah, I see. So it's like getting paid extra on the stocks they already hold. One source described it as like getting tech growth exposure with added income. Like avocado toast, you get the toast plus the avocado.
That's a decent analogy.
Yeah.
It's about combining potential growth from the tech stocks with this extra income stream from the options. It can also potentially smooth out the ride a bit compared to just holding volatile tech stocks directly.
So the pros seem to be that high monthly income potential, exposure to quality tech, maybe lower volatility than just a pure tech growth fund.
Exactly. Those are the main draws.
But what's the catch? What are the downsides?
Well, the main trade-off with covered calls is that you cap your potential upside. If those tech stocks really soar way past the price where the option holder can buy,
Right.
the fund might have to sell those shares at that lower capped price, missing out on those bigger gains.
Okay, so you sacrifice some potential big wins for more regular income?
Pretty much. And you're still tied to the NASDAQ. If tech has a bad run, this fund's going to feel it, even with the option income cushion.
Gotcha. And the numbers. The yield is apparently around, 11.5%?
Yeah, approximately.
Yeah.
Which, on a hypothetical $100,000 investment, could translate to maybe $958 a month.
Nearly $1,000 a month from just one fund.
Okay.
But with that potential growth cap, let's move to number 2. RYLD, the Global X Russell 2000 Covered Call ETF. This one's been called the crazy cousin with the best pie. Bit of a character. It focuses on small cap stocks, the Russell 2000 index, also using covered calls.
And that crazy cousin label kind of fits because the Russell 2000 itself is, well, it's a different beast.
How so?
It's made up of smaller companies. Some have huge growth potential. They could be the next big thing. Others might, fizzle out completely. It's inherently more volatile than large cap indexes like the NASDAQ 100 or S&P 500.
So more potential boom or bust in the underlying stocks.
Exactly. RYLD tries to generate income from this volatile space using those covered calls. The main attraction here is often the potential for a very high yield.
Yeah, the numbers look big, around 13.5% yield. That could mean, $1,125 a month on that same $100 K investment?
Potentially, yes.
Yeah.
It's often one of the highest yielding covered call ETFs out there.
So, pro, massive income stream, monthly payouts, maybe diversifies income away from just tech.
Right. But the cons are significant too. That underlying volatility is the big one.
Need a strong stomach.
Definitely. And capital appreciation. As one source joked, LOL, good luck. The focus is overwhelmingly on income, and the fund's price itself could swing quite a bit.
Okay, huge income potential, but buckle up for the ride. Now let's talk about QYLD, the Global X NASDAQ 100 Covered Call ETF. This is positioned as RYLD's more stable sibling, right?
Yeah, that's a good way to put it. It uses the same covered call strategy, but applies it to the NASDAQ 100 index, the bigger, more established tech and growth companies.
The Apples, Microsofts again, mostly.
Right. And it's developed this reputation. Darling of income chasers, maybe like a reliable Costco rotisserie chicken. Consistent, predictable.
Huh. Okay, so reliable income is the name of the game here.
Pretty much. Because the underlying companies are generally larger and more stable than those in the Russell 2000, the income stream can be more predictable, though never guaranteed, of course.
And the yield, around 12%. So maybe $1,000 a month on 100K. Still very solid.
Very solid, yes. It's popular for a reason among income investors.
So if it's the reliable choice, what's the downside compared to, say, JEPQ, which also covers the NASDAQ?
The main downside, similar to JEPQ and RYLD, is that limited growth potential. That covered call strategy inherently caps the upside.
Right. The same trade-off.
Exactly. If the NASDAQ 100 goes on a tear, QYLD will likely lag behind a standard NASDAQ 100 index fund significantly. It's built for income, not really for maximizing total return in a bull market.
Okay. Predictable income, solid tech exposure, but don't expect huge growth.
Got it.
Now we're shifting gears a bit. Fund number 4, HTD John Hancock Tax Advantage Dividend Income Fund.
A closed-end fund, this one.
Right, not an ETF, and it invests in preferred shares and dividend-paying stocks. The big hook seems to be tax advantage income, like a burger joint secretly taking off 30%. How does that work? What makes it tax advantage?
Well, closed-end funds, or CEFs, like HTD, can structure their payouts in ways that might be taxed more favorably. Some of the distribution might be classified as qualified dividends, which get lower tax rates than regular income. Or sometimes part of it might be considered return of capital, which isn't taxed immediately but reduces your cost basis. It depends on the specifics each year, but the potential for tax efficiency is a key feature.
And it seems more diversified, too, not just tech.
Definitely. HTE invests across various sectors, utilities, telecoms, financials, and includes preferred shares, which are kind of a hybrid between stocks and bonds. So yes, broader diversification than the covered call ETFs we just discussed.
So pros, potential tax savings, broader diversification. The yield is a bit lower, though, around 9%. That's about $750 a month per $100 K.
Correct. Lower yield than the covered call strategies generally.
What are the specific cons or things to watch with a closed-end fund like this?
One key thing with CEFs is that their market price can differ from the actual value of the assets they hold, the net asset value, or NAV, meaning the shares might trade at a discount to the NAV. You pay less than the asset's worth. Or at a premium, you pay more. This discount or premium can fluctuate, adding another layer of volatility or opportunity, depending on how you look at it.
Okay, so the share price isn't always perfectly tied to the underlying asset value. Interesting. Next, Fund 5, PDI, the PIMCO Dynamic Income Fund.
PIMCO, a big name in bonds.
Yeah, called the gold standard in fixed income. PDI invests in things like high-yield corporate debt, sometimes called junk bonds, mortgage-backed securities, emerging market bonds, stuff that sounds potentially risky.
It definitely operates in the higher risk, higher yield segments of the bond market. That's where PIMCO's expertise comes in.
The source says they collect checks like a bond villain. What kind of expertise are we talking about? How do they manage that risk?
Well, PIMCO has vast resources, deep research teams, experienced managers who specialize in analyzing credit risk, interest rate movements, global economic conditions. They actively manage the portfolio, trying to identify opportunities and mitigate risks in these complex markets.
So active management is key here.
Very much so. You're relying on their skill to navigate those potentially choppy waters.
And the potential income reflects that risk reward. Yield around 13%. That's potentially $1,083 a month on $100, right up there with RYLD.
Yes, the income potential is significant. That's the main appeal.
What are the biggest risks then, even with PIMCO at the helm?
Interest rate sensitivity is a big one for most bond funds, especially those holding longer-term or lower-rated debt. If rates go up, the value of existing bonds tends to go down.
Okay.
And, of course, credit risk. High-yield bonds have a higher chance of default than investment-grade bonds. PIMCO tries to manage this through diversification and selection, but the risk is inherent in that asset class.
Got it. High potential income, but sensitive to rates and credit quality. Okay, last one. Fund number 6. UTF Cohen & Steers Infrastructure Fund.
Another CEF, focused on infrastructure.
Right, described as the blue-collar workhorse, investing in essential stuff, electricity grids, water systems, pipelines, toll roads, cell towers, broadband. Real assets.
Exactly. Things that are generally essential for society to function.
Why is that seen as dependable for income?
Because demand for these essential services tends to be relatively stable, even during economic ups and downs. These assets often have long-term contracts or operate in regulated environments, which can lead to predictable cash flows.
So reliability is the key theme.
Yes, reliability and the tangible nature of the underlying assets. Infrastructure can also sometimes offer a degree of inflation protection, as tolls or utility rates might rise with inflation.
Makes sense. Now, the yield is the most modest of the group, around 8.5%. That's about $708 a month per $100.
Correct. More conservative on the yield front compared to the covered call or high-yield bond options.
What are the downsides or risks with an infrastructure fund like UTF?
Like PDI, it can be sensitive to interest rates. Higher rates make borrowing more expensive for these capital-intensive infrastructure projects.
Okay.
And while often stable, these companies aren't immune to regulatory changes or specific operational issues. And again, as a CEF, it can trade at a discount or premium to NAV.
All right, so we've got JEPQ, RYLD, QYLD, HTD, PDI, and UTF. 6 different approaches to income. The scenario we started with was investing $100,000 in each. Total, $600,000.
Right.
Let's quickly recap those potential monthly incomes per $100. JEPQ, $958, RYLD, $725, QILD, $1,000, HTD, $750, PDI, $1,083, and UTF, $708. If you add all those up,
Right.
what does that come to?
Adding those numbers gives you a total potential monthly income of around $5,624.
Wow. So over the $5,000 target, annually, that's about $67,488.
Approximately, yes, based on those current years.
That's the core idea, yes. Generating an income stream from the portfolio itself.
But obviously, it's not guaranteed. We can't just pencil in $5,624 a month and call it a day, can we?
Absolutely not. That's crucial to understand. These are potential figures based on current or recent yields. Dividend yields fluctuate, fund prices go up and down, dividends themselves can be cut or suspended.
Right. Interest rates change, the economy changes. All of that impacts these funds. This isn't a magic money machine. It's an investment strategy with inherent risks. It's presented as a get paid slowly and steady plan, not get rich quick.
So what are the key things someone attempting this needs to keep in mind? The sources mentioned rebalancing, reinvesting.
Yes. You can't just set it and forget it. You need to monitor the portfolio, probably rebalance periodically to maintain your desired allocation across the funds. Decide whether to reinvest some or all of the income, especially if you don't need it all immediately.
And stay informed about the economy, interest rates.
Definitely. And critically, the sources warn against putting all your money into just one of these ETFs or funds. Diversification is key.
Which brings us to that diversification point. The sources group these nicely. You have the covered call ETFs, JEPQ, QYLD, RYLD.
Yep, generating income from options on equities.
Then the tax-advantaged and diversified equity CEFs, HTD, UTF.
Providing exposure to different sectors, preferreds, infrastructure with potential tax benefit.
And finally, the high-yield fixed income CEF, PDI.
Getting income from bonds and debt instruments managed by specialists.
The analogy used was a Voltron of monthly income, combining these different strategies for greater strength. Why is mixing strategies like this so important?
Because these different strategies tend to behave differently under various market conditions. Tech stocks might soar while bonds struggle, or vice versa. Infrastructure might be steady when small caps are volatile.
Ah, so they don't all move in lockstep.
Exactly. By combining strategies that have low correlation with each other, you aim to smooth out the overall portfolio's performance and income stream. If one part is having a tough time, hopefully another part is doing okay, providing balance. It's fundamental risk management.
Makes perfect sense. You're spreading the risk not just across funds, but across how those funds make money.
Precisely.
Okay, wrapping up, there was a final kind of snarky tip in the source material. It basically said to ignore people who dismiss stable investments like bonds or dividend payers just because they aren't the latest, hottest speculative thing.
Good reminder.
The point was, real wealth isn't about gambling. It's about sleeping soundly at night while your money does the heavy lifting. I like that.
It's a solid perspective. Chasing hype can be exciting, but building sustainable wealth often involves these more, perhaps, boring, but potentially reliable income strategies. This kind of diversified approach offers a path, not the only path, but a path towards that goal.
So, thinking about all this deep dive gives a really concrete example, doesn't it? How a mix of income funds could potentially generate significant monthly cash flow. It really makes you think, how could that kind of consistent income reshape your own long-term plans?
It definitely shifts the focus from just growth to sustainable income.
Yeah. So maybe the question for listeners to ponder is, how might this kind of strategy fit or not fit into your own financial picture? What more would you need to look into to figure that out for yourself?